Hello, this is our classes. I am Dr. K.K. Misra. I welcome you all to my channel, our classes. If you like this video tutorial, please do not forget to subscribe it and press the bell button. This is about MCQ on financial derivatives part 2. Financial derivatives is one of the subjects in MBA final semester of AKTU. Now come to the question. Question number 1. Which of the following is a reason to hedge a portfolio? Options are A. To increase the probability of gains, B. To limit exposure to risk, C. To profit from capital gains when interest rates fall, D. All of the above, E. Both A and C of the above. Correct option is B. To limit exposure to risk. Question number 2. Hedging risk for a long position is accomplished by, options are A. Taking another long position, B. Taking a short position, C. Taking additional long and short positions in equal amounts, D. Taking a neutral position, E. None of the above. Correct option is B. Taking a short position. Now move to next slide. Question number 3. Hedging risk for a short position is accomplished by, options are A. Taking a long position, B. Taking another short position, C. Taking additional long and short positions in equal amounts, D. Taking a neutral position, E. None of the above. Correct option is A. Taking a long position. Now question number 4. A contract that requires the investor to buy securities on a future date is called a, options are A. Short contract, B. Long contract, C. Hedge, D. Cross. Correct option is B. Long contract. Question number 5. A person who agrees to buy an asset at a future date has gone, options are A. Long, B. Short, C. Back, D. Ahead, E. Even. Correct option is A. Long. Move to next. Question number 6. A long contract requires that the investor, options are A. Sell securities in the future, B. Buy securities in the future, C. Hedge in the future, D. Close out his position in the future. Correct option is B. Buy securities in the future. Question number 7. A short contract requires that the investor, options are A. Sell securities in the future, B. Buy securities in the future, C. Hedge in the future, D. Close out his position in the future. Correct option is A. Sell securities in the future. Next slide. Viewers, let me tell you that by and large, the correct options are highlighted. In case of any discrepancy found, that will be removed in my narration. Now, question number 8. A contract that requires the investor to sell securities on a future date is called a, options are A. Short contract, B. Long contract, C. Hedge, D. Micro hedge. Correct option is A. Short contract. Question number 9. If a bank manager chooses to hedge his portfolio of Treasury securities by selling futures contracts, he, options are gives up the opportunity for gains, B. Removes the chance of loss, C. Increases the probability of a gain, D. Both A and B are true. Correct option is D. Both A and B are true. Now question number 10. To say that the forward market lacks liquidity means that, options are A. Forward contracts usually result in losses, B. Forward contracts cannot be turned into cash, C. It may be difficult to make the transaction, D. Forward contracts cannot be sold for cash, E. None of the above. Correct option is C. It may be difficult to make the transaction. Viewers, let me tell you that if you like this video, please do not forget to subscribe and press the bell button and forward it to many those who are in need of this content. Question number 11. A disadvantage of a forward contract is that options are A. It may be difficult to locate a counterparty. B. The forward market suffers from lack of liquidity. C. These contracts have default risk. D. All of the above. E. Both A and C of the above. Correct option is D. All of the above. Question number 12. Forward contracts are risky because they, options are A. Are subject to lack of liquidity. B. Are subject to default risk. C. Has a portfolio. D. Both A and B are true. Correct option is D. Both A and B are true. Question number 13. The advantage of forward contracts over future contracts is that they, options are A. Are standardized. B. Have lower default risk. C. Are more liquid. D. None of the above. Correct option is D. None of the above. Question number 14. The advantage of forward contracts over futures contracts is that they, options are A. Are standardized. B. Have lower default risk. C. Are more flexible. D. Both A and B are true. Correct option is C. Are more flexible. Question number 15. Futures contracts are regularly traded on the, options are A. Chicago Board of Trade. B. New York Stock Exchange. C. American Stock Exchange. D. Chicago Board of Options Exchange. From among the options available, though these are foreign stock exchanges, if you compare, you will find that A to be the correct answer, Chicago Board of Trade. Question number 16. Forward contracts are of limited usefulness to financial institutions because options are A. Of default risk. B. It is impossible to hedge risk. C. Of lack of liquidity. D. All of the above. E. Both A and C of the above. Correct option is E. Both A and C of the above. Question number 17. Hedging in the futures market. Options are A. Eliminates the opportunity for gains. B. Eliminates the opportunity for losses. C. Increases the earnings potential of the portfolio. D. Does all of the above. E. Does both A and B of the above. Correct option is E. Does both A and B of the above. Now, question number 18. When interest rates fall, a bank that perfectly hedges its portfolio of Treasury securities in the futures market, options are A. Suffers a loss. B. Experiences a gain. C. Has no change in its income. D. None of the above. Correct option is C. Has no change in its income. Question number 19. Futures markets have grown rapidly because futures, options are A. Are standardized. B. Have lower default risk. C. Are liquid. D. All of the above. Correct option is D. All of the above. Now, question number 20. Parties who have bought a futures contract and thereby agreed to dash obviously take delivery of the bonds are said to have taken a position, a dash position. Options are A. Sell short. B. Buy short. C. Sell long. D. Buy long. Correct option is D. Buy long. So this was all about this video tutorial. Thank you. Please like, share and subscribe. Thank you very much. Have a nice time. Best of luck.